I think we've had a rolling recession through different parts of the economy at different times. Truck drivers, huge recession, car companies, big recession. There's a bunch of indicators that show that. The tech companies, don't forget, they laid off all of their staff beginning of the year, and continuing claims are rising again. So somebody else is laying off workers now. So I think it's been ongoing, but I think this quarter and next quarter will be the weakest because the ISM is at its lows, and the ISM is at levels, which is the best indicator of the business cycle, is around 46, which has historically given us a 100% chance of recession. So I think we're probably in a recession, but it's been this kind of rolling recession. So my view was always it's never going to be a bad recession. It'll more be like 1990, which is a mild recession, but with a lot of overhangs afterwards. Commercial real estate being one. Unemployment will be stickier than people expect because of the rise of AI and other things.
President John Williams of the Federal Reserve Bank of New York restated that the Fed's benchmark lending rate has either reached or is near its peak level. He emphasized that the current monetary policy is considerably restrictive, with rates projected to be the most stringent in the past 25 years. Speaking at the Bretton Woods Committee conference at the New York Fed on Thursday, Williams expressed his belief that maintaining a restrictive stance for an extended period is appropriate to fully restore balance and bring inflation back to the 2% longer-run goal on a sustained basis. As of now, headline inflation has significantly cooled from its peak level of 10.6% in October 2022. In the Eurozone's largest economies, Germany and France, inflation rates have dropped to 3.2% and 3.4%, respectively. Despite these improvements, officials from the ECB have consistently emphasized that it is premature to declare victory over price rises in the 20-member Eurozone bloc. They continue to monitor potential pressures from wage increases and energy markets. In a video, Raoul delves deeply into macroeconomic discussions, providing detailed insights into the debt spiral and its impact on the economy. He extensively addresses topics such as inflation and the erosion of the American dream.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
The debt problem is really interesting. 2008, every major government in the world of a developed economy hit 100% of GDP in debt. So, okay, and interest rates, let's say 5-year interest rates where they generally finance themselves, have averaged around 2% or less. But so is economic growth. So if you think of GDP as all of the money circulating around to pay for the debt, there's no more money left over. But the problem is the private sector is over 100% of GDP in debt in every major country. So who pays for that debt? So that's when they started shoving the interest payment debt onto the balance sheets, because the world basically hit the tipping point in 2008, and people still haven't worked this out. But I think I was the first person, and still maybe the only person, who's gone back and calculated all of the interest payments and realized that they are, and the balance sheet growth, and realized that they are just 3.5 years apart, the same chart. They just keep monetizing it. And that's the way that they see out of the debt, is to mutualize those payments across everybody by increasing the balance sheet. But the debt doesn't go away because GDP is not growing fast enough. So you have to change the GDP formula. If not, you're in this endless trap where you're printing more and more money, making the rich richer, the poor poorer, ad infinitum. And I think that for individuals, as I said, there's only 2 assets that outperform this. That's technology and that's crypto. Okay, fine. The economy, that's really hard to get this to sort itself out. People are waiting for a collapse, the market's down 80%. It can't. The reason it can't is the central bank debased the currency and it makes the stock market go up optically, because they can't allow the collateral of the system to go bust. So they don't allow the system to go bust, and it creates this ongoing problem. But if you listen to the narratives from the central banks and the governments, what they're really saying is the whole green energy revolution. Europe is massively funding this. And yes, it's good for the planet. Yes, it's good for a number of things. But really what they're trying to do is lower the cost of electricity. Because if you lower the cost of electricity, it has this multiplier effect on productivity. And that's how you can grow GDP growth. The other thing is population. Well, we're shrinking populations, as I said, so we have to replace people. So look at Amazon warehouses. The growth is not in people. The growth is in the robots. The robots work 24/7, 365. They never complain, and they cost a fraction of a human. So every company is incentivized to employ robots to do jobs instead of humans. Then this year, we had the nuclear bomb of deflation, which is human knowledge, lawyers, doctors, accountants, creative artists, developers, everybody, and they're replaceable via the infinite knowledge machine that is AI. So that's scary for us as individuals. But if population growth is a large part of the components of GDP growth, you can create infinite people by the robots and AI. So there are schools of thought, even coming out of Oxford University, that says we could hit a tipping point where the GDP of the planet doubles in a year or even a week. Now that sounds extreme, but if you put infinite people or infinite productive units into the economy, you can make infinite goods. Now, who pays for the goods? Maybe the machines pay for the goods. We don't know. This is a whole new economic system being built in front of our eyes. This is something I call the exponential age, which is where all of these technologies are coming together, from energy to AI to robotics to EV to space to 5G, 6G, all of these things, biotech, all coming together, genetic sciences, to create this fastest period of technological change in all of humanity. And it's the only way out, and it's scary.
Jamie Dimon, the CEO of JP Morgan, asserts that the United States is essentially addicted to debt, placing the economy in a precarious position. Dimon, the chief of Wall Street banking, highlights the substantial increase in U.S. debt since the onset of the pandemic, including approximately $1 trillion in distributed stimulus checks and the $4 trillion disbursed by the Federal Reserve to purchase government bonds. These measures injected a significant amount of cash into U.S. markets, resulting in increased profits for leading firms and a surge in stock values throughout 2021. Dimon likens this influx of money to a drug, stating at the Global Investment Summit in London, as reported by The Telegraph, that money is like heroin. Following the debt-fueled stimulus, inflation ensued, prompting the Federal Reserve to take measures to curtail the excessively loose monetary policy. This move is perceived as a threat that could potentially induce market instability and trigger withdrawal effects. Dimon suggests that stocks may experience a downturn in 2022, with markets anticipating significant bouts of rate-induced volatility throughout 2023.
The last 5 major inflations since World War II, and then just map this current one against it. It's identical. They all kind of are the same thing. They go up and go down. It looks like Mount Fuji. It's almost symmetrical. We're seeing it already in Europe where PPI numbers, Norway hit a negative 42% PPI. I mean, this is staggeringly disinflationary or deflationary. So my view is that when we see the kind of November, December inflation numbers in January, we will start to see inflation at 2% or lower. And that will continue, I think, to potentially deflation in the headline numbers. The core inflation and headline inflation is actually driven not by commodity prices and all of this fast-moving stuff. It's actually driven by 2 things: wage increases and owner equivalent rents, both of which are going down, are deflating. And all the forward-looking indicators suggest that they are likely to go negative. So I think there is a chance even of core inflation going negative in 2024, which is very much the opposite of what anybody else's view is. Most people, I think there's myself and Alex Gurovich are the only 2 people who've got this view. Almost everybody else thinks we're going to see sticky inflation. I just don't think we will. There's a lot of false narratives in macro, and a lot of it is based on politics. People put their political views into their economic views and then create market views around them. So there's a general desire for a recession and markets to fall. And that's driven by people who are really all about how is inflation created? The central banks have destroyed our world, and I want to show everybody that it's happened. Yes, the central banks have destroyed our world, but not in the ways that they think. We've had the use of the balance sheet for over a decade now, and in Japan even longer. It never generated inflation. But they want that inflation because they want to prove that the monetarism is the kind of holy grail that they worship. And it's the people who worship Volcker, for example, come with different angles. So a lot of people are imposing perspectives that they hold from political opinions. And so the narratives become overwhelming. And I've actually gone on Twitter and said, okay, if you think sticky inflation, how do you vote? sticky inflationists are Republicans in general. And it's just because of how the construct of how people see the world. What I try and do is not look at that. I mean, at Global Macro Investor, we have 2,000 charts. And we just try and use the data and not impose our own views on the data, and see what that comes out with. And that gives us the high probability that inflation just reverts back to 2% or lower. Doesn't mean I'm definitely right, but it comfortably gives me a decent probability, I think. So when you debase a currency, it doesn't let wages go up or even corporate earnings go up. It makes asset prices go up. So those who can afford assets outperform or at least protect their wealth. Everybody else who earns wages and doesn't have much assets, they get their future self. An asset is your ability to put money in now and take it out later. It's future deferred consumption. If you can't buy assets, your future self is getting poorer. That's why we have a pension system. That's why people buy real estate. That's why they buy gold. All of these things. So what they're doing by debasing the currency by whatever the number is, 15% a year, is they are mutualizing the costs of servicing the debt. But it's mutualizing it across the poorer people, which is what makes everybody so angry, because they don't understand this card trick that's being played on them. It's the same as raising taxes on them all, but they don't realize. They just know that something's not right. Why do my wages not really go up, but everything else goes up around me? Why can't I afford a house and my parents could afford a house? Why could my parents have, a larger percentage in their 401k and I can't? It's because of this. And that's what the central banks are doing.
OPEC and oil producers reached an agreement on Thursday for voluntary output cuts of nearly 2 million barrels per day for the early part of next year. Saudi Arabia, leading the initiative, decided to roll over its existing voluntary cut. Despite failing to reach a consensus on a group cut during a virtual meeting on Thursday, Saudi Arabia, Russia, and other OPEC Plus members, who collectively account for over 40% of the world's oil, agreed to individual voluntary cuts. Oil prices initially rose by over 2% but later declined, with benchmark Brent crude for February futures dropping 1.6% to $81.52 per barrel at 17:47 Greenwich Mean Time. Additionally, OPEC Plus extended an invitation to Brazil, a top 10 producer, to join the group. Brazil's energy minister expressed the country's intention to join in January. The group convened to discuss 2024 output, addressing concerns about a potential market surplus, especially with the expiration of Saudi Arabia's 1 million barrel per day cut next month. OPEC Plus already achieves an output of around 43 million barrels per day, reflecting cuts of approximately 5 million barrels per day aimed at supporting prices and stabilizing the market. Saudi Arabia confirmed its voluntary cut extension for the first quarter of 2024, and Russia's Deputy Prime Minister, Alexander Novak, announced the extension of Russia's voluntary cut by 500,000 barrels per day for the same period. OPEC Plus is focusing on reducing output as prices have fallen from nearly $98 in late September, coupled with concerns about weaker economic growth in 2024 and expectations of a supply surplus. The International Energy Agency projected a slowdown in demand growth for 2024 as the final phase of the pandemic economic rebound wanes. The OPEC Plus meeting coincided with the commencement of the United Nations COP28 Climate Summit hosted by OPEC members in the United Arab Emirates. Feel free to share your thoughts on the rising levels of U.S. debt and its potential impact on the economy in the comments section below. For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.